Hello and welcome back. I'm Natalie MacDonald and you're joining me for today's Sydney Direct on Dukascopy TV with a look at all of the latest going-ons on the Australian markets. Well, as the RBA and the US Federal Reserve continue to play tug-of-war over the Australian share market, I spoke to Scott Phillips at the Motley Fool to find out exactly what that inevitable US interest rate hike could mean for Australian investors. Scott Phillips, thank you so much for joining us today on Dukascopy TV. A pleasure to receive your comments.
Thank you, Natalie. Good to be with you.
Okay, so we're talking RBA and the US Federal Reserve. Now, a UBS strategist recently stated that the US Fed has been able to show more patience than the RBA, in fact, can. Would you agree?
Yeah, that's exactly the case right now. The US has really taken a very cautious approach. The economy is going ahead in leaps and bounds effectively, but the Fed's really reluctant to raise rates because they're worried about stalling that economic recovery. Here in Australia, Glenn Stevens got the other concern. There's an economic slowdown. Mining activity, of course, is falling off at a pretty fast rate of knots, and the non-mining economy here isn't picking up at the same pace. So the Reserve Bank governor is having to try and manage a slowdown in one part of the economy, a slow improvement in the other part of the economy, and having to be more proactive than I think he'd like to, and certainly than the US Fed needs to be, given the states of the different economies.
The RBA has really pegged its monetary policy, its currency stance, really everything going to US Fed action. How damaging do you think sort of these dovish tones that we're seeing towards a US Fed rate hike, how damaging do you think that they've really been to the RBA's own positioning?
Yeah, the best thing Janet Yellen can give Glenn Stevens, the RBA governor, for Christmas is a rate cut rate rise in the US. Glenn Stevens has to do all the work right now to bring Australian rates down closer to US rates to try and get the Australian dollar down to 75 US cents. They've said that out and very, very clearly that's their target. As we speak, it's about 78 US cents, give or take. That's going to be too high for Glenn Stevens over the medium and long term. He's hoping for an export-led recovery effectively to offset that mining we talked about. Not only does it help the miners themselves get more Australian dollars for their exports, but it helps other Australian exporters, and it also helps, of course, the local manufacturers compete with imports. So the local non-mining economy largely needs a better Australian dollar, a lower Australian dollar versus the US to really kickstart that growth and give us some export potential. That's the challenge right now, and Glenn Stevens has to effectively use the differential between those two rates and maintain that himself. As soon as the US Fed starts to move, it lightens his load quite a lot, but in between there, he's got to make sure the economy doesn't stall, and that's forcing his hand, particularly in Australia. We've got somewhat of a property bubble in Sydney, partly in Melbourne, our second largest city. That's going to cause some concern if it is in their place for too long. But again, Glenn Stevens has to balance out this impact of, yes, there might be some asset price inflation going on, but he's got to keep the physical economy rolling, and right now that means rate cuts.
You've already mentioned there, we did see the Aussie dollar head up against the greenback following that US Fed meeting and the RBA meeting minutes. As you say, it's sort of still inching ever so slightly higher. There's been some disparity about what that inevitable rate hike could actually do to the Aussie dollar. As you said, the RBA is wanting to see it lower. Where do you actually see it likely to sit?
This is the challenge. Janet Yellen was probably more dovish than people expected at the last announcement. Some people were hoping for either a stronger rate rise either up front or some sort of timetable saying there'd be more rate rises soon to follow the first one. There's pretty good consensus that the first US rise comes this year sometime, but there's also hope that maybe it might happen again, once, twice, three times next year. Now it's not less certain that's going to be the case. I think Yellen really saying they're going to sit back and wait and see what happens. Whatever that's the case, that really does put the pressure back on Glenn Stevens to do something to make, to do enough to keep the economy moving. And that's really what it comes down to. Again, it's that exchange rate question of, can the local economy do enough, given that, relatively high level against the US dollar, much higher than the Australian Reserve Bank wants. That's got to be the key concern. And right now, while the US rate rises are likely to be slower and possibly lower than was previously thought the case, that's going to push the Australian dollar up. And that's exactly not what the RBA governor wants to see.
Let's shift this sort of Australia-US discussion then really to look at the stock market. And we see the local share market follow Wall Street lower or higher, wherever it's going, just as often as it almost shrugs off those overseas leads. What level of correlation do you actually see, and how does that look to shape your performance over that mid to long term period? And also, are we going to be seeing something akin to that taper tantrum we saw previously around US Fed action? Yeah,
great question, Natalie. Look, in terms of the the correlation, there is a long term correlation, largely because we're two developed economies with the same global trends. The Australian and US economies are fairly similar, let's be honest, differences of course, but largely similar. So as as those broader macro impacts happen in the US, they're going to happen here in Australia and vice versa. It's rare. The Australian minerals boom, by the way, was one example of where there was a break in that correlation. But if the broader economies track largely side by side, you're simply going to see the stock markets do the same, because it's the profits of those companies operating in those economies that makes the difference. So yes, over the medium and long term, you're going to see correlation, not for any special reason, but because the macro effects happen the same in both countries to a large degree. The taper tantrum is a good question. This is going to be a short-term blip on the radar. The market should by now. Janet Yellen has been very, very accommodative in her language. She's been very clear with the markets about what to expect, when to expect it, how she's thinking. If anyone's genuinely surprised by this or reacts strongly to it in a short-term phase, that's really their own misjudgment when it comes to their trading or investing strategies. You've got to be looking through those things. It's going to happen sometime soon. If you're going to react badly to it, you've really taken the wrong approach in the first instance. There are people investing on the basis of continued low rates. They might get shaken out if they're taking a different view to the Fed. If you're taking some sort of contrarian view and saying, well, maybe the rate cuts won't come as hard, they won't come as soon, maybe you're trying to play that rate differential, and that's also going to cause some dislocation if and when it happens. But gee, Janet Yellen couldn't have done much more than be very, very clear with the markets as to what she's saying, what she's thinking, what the market should expect. If there's a taper tantrum, again, that's more about investors and traders' responses than the Federal Reserve's action itself. That's probably the key message is, expect it, it's going to come. And by the way, your investment case shouldn't be based on one rate rise and if and when it happens.
Scott, thank you so much for your comments. We look forward to catching up with you again in the near future. Thank you.
Look forward to it. Thanks, Natalie.
We look forward to speaking to Scott Phillips at the Motley Fool again very soon. Do stay tuned, as I'll be bringing you plenty more exclusive updates on the Australian markets right here on Sydney Direct. For now, though, it's goodbye.